Imagine spending decades chasing the stock market, pouring hours into research, obsessing over charts, bouncing from one hot stock tip to another, only to realize you've been running in circles while Wall Street quietly gets rich off your efforts. You see, this is the harsh reality for millions of hardworking people. They hustle, they grind, they dive into the chaos of financial markets, convinced that with just the right amount of effort, they'll unlock the secret to wealth. But what if I told you the real path to building wealth isn't hidden behind complicated jargon, exclusive hedge funds, or risky stock picks? What if the key has been right in front of you all along? So simple, so obvious, it's common sense. In today's video, I'm going to share the timeless investing wisdom from one of the greatest financial minds of our time, John C. Bogle, the founder of Vanguard and the revolutionary behind index fund investing. His legendary book, The Little Book of Common Sense Investing, distills decades of experience and cold, hard truth into simple principles that anyone, yes, even you, can use to create long-term financial security. No more sleepless nights worrying about market crashes, no more feeling like investing is some exclusive club reserved for Wall Street insiders. Bogle's message is clear. Ordinary people can win the investing game not by outsmarting the market, but by owning it. By the end of this video, you will walk away with a clear, actionable strategy to build real wealth. You'll understand how to sidestep Wall Street's traps, avoid costly mistakes, and let your money grow with minimal effort. No more confusion, no more second-guessing, just a rock-solid foundation for your financial future. And here's the best part. It doesn't matter if you're completely new to investing or if you've been in the game for years but feel stuck, overwhelmed, or frustrated. This video will bring you the clarity, the confidence, and the power to finally take control of your financial destiny. The truth is, the markets will rise and fall. The headlines will scream panic and euphoria, but wealth belongs to those who stay the course with discipline, patience, and common sense. If you're ready to stop spinning your wheels and start building the life you deserve, stay with me, because what I'm about to share could transform how you look at money, investing, and your future forever. Chapter 1. The True Essence of Investing. Owning Businesses. When most people hear the word investing, their minds instantly jump to flashy images. Day traders glued to computer screens, stock market apps buzzing with updates, financial news anchors predicting the next big crash, or viral success stories about someone turning a few thousand into millions overnight by gambling on the latest trending stock. It's no wonder so many feel overwhelmed or intimidated by investing. It appears chaotic, risky, and reserved for the brave or the lucky. But here's the truth most of Wall Street won't tell you. Real investing isn't about gambling, guessing, or riding waves of hype. At its core, investing is simply this: owning a piece of real businesses that drive the economy forward. John C. Bogle, the visionary founder of Vanguard and author of The Little Book of Common Sense Investing, devoted his life to teaching this principle. He believed that when you invest properly, you become part owner of companies that provide goods, services, and innovations the world depends on. You're not just buying numbers on a screen. You're owning businesses that produce real value, create jobs, and fuel economic growth. That shift in mindset changes everything. Why does this matter so much? Because when you see investing for what it truly is, business ownership, you naturally tune out the hype, the panic, and the noise that dominate financial headlines. You're no longer tempted by get-rich-quick schemes or swayed by market fluctuations that mean little in the grand scheme of wealth building. You stop obsessing over daily stock prices and start focusing on building something stable, resilient, and meaningful. You begin to think like a business owner, not a gambler. Think about it this way. If you owned a local coffee shop, would you consider selling your entire business just because a news report suggested coffee prices might rise next month? Of course not. You'd focus on running the shop, serving customers, and building your brand, understanding that success takes time. Yet when people buy individual stocks or chase market trends, they often panic at the first sign of uncertainty, forgetting they're supposed to be owners, not speculators. That's the trap Bogle warns against: confusing speculation with true investing. So how do ordinary people apply this mindset practically? The answer lies in broad, diversified index funds. Rather than trying to pick individual stocks, which often leads to underperformance, stress, and losses, index funds allow you to own small pieces of hundreds, even thousands of companies at once. It's like owning a slice of the entire economy. With a single investment, you gain exposure to businesses across industries, technology, healthcare, finance, consumer goods, spreading your risk and positioning yourself to benefit from overall economic growth. This approach isn't theory, it's proven by decades of success stories. Let me share a simple yet powerful example. Consider the story of an ordinary couple, school teachers, earning modest incomes with no formal financial training. They didn't chase hot stocks, time the market, or obsess over financial news. Instead, they steadily contributed to low-cost index funds year after year through retirement accounts. They understood they were building ownership in real businesses, the same companies shaping our daily lives, and they trusted the process. Fast forward 30 years, and their consistent, patient approach compounded into substantial wealth, far beyond what most people believe possible on an average salary. This is the magic of common sense investing. It isn't reserved for the elite, the insiders, or the financial geniuses. It's for anyone willing to adopt the right mindset and stay the course. By focusing on owning diversified businesses through index funds, you bypass the stress of individual stock picking, avoid the traps of speculation, and tap into the long-term growth of the global economy. This requires discipline and perspective. The market will fluctuate. There will be downturns, scary headlines, and moments of doubt. But businesses, the backbone of the economy, adapt, grow, and push forward. When you invest wisely, you ride that wave of progress, benefiting from innovation, productivity, and global growth. Bogle's philosophy is simple but powerful. Stop thinking like a speculator chasing quick wins and start thinking like a business owner building true, lasting wealth. This approach doesn't promise overnight riches, but it does offer the most reliable path to financial freedom for the average person. It's about patience, understanding, and faith in the long-term potential of businesses, not the short-term noise of markets. So let me leave you with this reflective question. Are you chasing quick wins, constantly reacting to market swings, trying to predict the unpredictable? Or are you building true ownership in the economy, slowly, steadily, and with the confidence that comes from understanding what investing really means? Because once you embrace this common-sense approach, everything changes. You'll invest with clarity, sleep better at night, and steadily build the wealth you deserve, not through luck, but through owning the businesses that power the world forward. Chapter 2. The Relentless Math of Investment Costs. If there's one hidden danger quietly draining your wealth, one most investors never even notice, it's the relentless compounding effect of investment costs. Costs matter, and they matter far more than most people realize. Even the smallest fees, the seemingly insignificant management expenses, or the fine print charges that go unnoticed, can quietly erode your returns year after year, until they carve a massive hole in your financial future. John C. Bogle, in the Little Book of Common Sense Investing, shines a spotlight on this uncomfortable truth, and it's one of the most important lessons any investor can learn. Think about it. We live in a world where people obsess over market predictions, stock-picking strategies, and economic forecasts. Yet, they often overlook the one factor completely within their control: costs. Bogle called it the tyranny of compounding costs. And once you understand the brutal math behind it, you'll never look at investing the same way again. Here's why this matters so much. Every dollar you pay in fees is a dollar that no longer works for you. And over time, that missing dollar doesn't just disappear. It takes with it all the compounded growth it could have generated. It's like a slow leak in your wealth-building engine, draining your potential silently, relentlessly, year after year. Let's break down the math. Imagine two investors, both contributing $10,000 per year into a retirement account over 30 years. They earn an average market return of 7% annually. But there's a catch. Investor A uses a low-cost index fund with an expense ratio of just 0.05%, while Investor B invests in an actively managed fund charging 2% in annual fees. At first glance, a 2% fee doesn't sound devastating. It seems small, almost harmless. But over decades, that tiny difference compounds into a massive wealth gap. After 30 years, investor A, the one using the low-cost index fund, accumulates roughly $944,000. Meanwhile, investor B, burdened by higher fees, ends up with only about $574,000. That's nearly $370,000 lost, vanished, not due to market crashes or bad luck, but because of fees that quietly compounded against them. Think about that for a second. The same market, the same contribution amounts, the same investment period, but drastically different outcomes, all because of costs. And here's the sobering reality. Many investors unknowingly fall into the high-fee trap. They chase actively managed funds, lured by promises of market-beating returns or expert management, only to discover that most of these funds fail to outperform the market consistently. Even worse, the hefty fees they charge often wipe out any small advantages they might occasionally deliver. John Bogle's research and decades of independent studies have proven this again and again. Over time, the majority of actively managed funds underperform simple, low-cost index funds. Yet they still collect their fees year after year, regardless of performance. Who wins in that scenario? The fund managers, not the investors. This is why Bogle championed low-cost index investing. Index funds track the overall market, delivering broad diversification with minimal costs. No high-priced fund managers making speculative bets. No hidden fees eating away at your returns. Just a straightforward, transparent, and cost-efficient way to own the market and keep more of your hard-earned money working for you. Now let me share another real-world story that illustrates this perfectly. Take the example of two friends, Sarah and David, both starting their investment journeys at age 25. Sarah chooses a total stock market index fund with a 0.05% expense ratio. David, on the other hand, follows the advice of a financial advisor who recommends a flashy, actively managed mutual fund with a 2% expense ratio. Both contribute $500 a month and stay invested for 40 years. By age 65, Sarah's disciplined, low-cost strategy grows her portfolio to approximately $1.5 million. David, despite making the same contributions and investing in the same market environment, ends up with only about $950,000. That's over $500,000 gone, vanished not due to market crashes or bad luck, but because of fees that quietly compounded against them. Think about that for a second. The same market, the same contribution amounts, the same investment period, but drastically different outcomes, all because of costs. And so can you protect yourself? It starts with awareness. Read the fine print. Understand expense ratios, management fees, and hidden costs. Choose index funds with rock-bottom fees, often available through companies like Vanguard, Fidelity, or Schwab. Stay vigilant, because every fraction of a percent matters over time. Bogle's message is crystal clear. Costs are the enemy of long-term wealth building. And the most dangerous costs aren't the ones you see. They're the ones buried in fund prospectuses, hidden behind marketing promises, and compounded silently year after year. So ask yourself this reflective question. How much of your hard-earned money is silently slipping into someone else's pocket? Are you unknowingly sacrificing your financial future to hidden fees? Or are you taking control by prioritizing low-cost, common-sense investments? The choice is yours. And as we'll continue to explore in this video, building lasting wealth isn't about predicting markets. It's about controlling what you can, eliminating unnecessary costs, and letting the power of compounding work in your favor. The math doesn't lie. Costs matter a lot, and understanding that simple truth can be the difference between financial struggle and financial freedom.
Chapter 3. Beating the market is a fool's errand. One of the most seductive ideas in the world of investing is the belief that with enough skill, research, or timing, you can consistently beat the market. It's a dream sold to millions by Wall Street, financial media, and investment gurus. They promise that if you just follow the right strategy, buy the right stock, or listen to the right expert, you'll outsmart the crowd and pocket extraordinary returns. But here's the inconvenient truth that John C. Bogle exposes in the Little Book of Common Sense Investing. Trying to beat the market isn't just extremely difficult, it's a fool's errand for most investors, and the statistics prove it. Let's get real for a moment. The financial world thrives on complexity. Hedge funds, day traders, and high-powered fund managers love to sell the illusion that with enough data, algorithms, or market savvy, you can stay one step ahead. But Bogle's decades of research reveal a far less glamorous reality. Over 10, 20, and 30-year periods, the vast majority of actively managed funds, those where professionals try to pick winning stocks or time the market, fail to outperform simple, low-cost index funds. Think about that. These are professionals with Ivy League degrees, supercomputers, teams of analysts, and insider connections, and yet most of them can't consistently beat the broad market over time. Now ask yourself, if they can't do it with all those resources, what are the odds the average individual investor can? Here's why this matters so much. Chasing market-beating returns often leads investors down a path of stress, frustration, and ultimately underperformance. You jump from one strategy to another, constantly react to market swings, or place your faith in the latest hot fund, only to find your returns lag behind the simple, steady growth of the overall market. It becomes an exhausting, often expensive cycle of disappointment. Bogle refers to this as playing the loser's game. In the short term, sure, some funds or individuals might beat the market, just like someone might win a hand at the casino. But over the long term, the odds are overwhelmingly against you. Markets are efficient, unpredictable, and influenced by countless factors beyond anyone's control. Trying to consistently predict their movements is like trying to catch lightning in a bottle. Occasionally possible, but never reliable. So what's the smarter approach? Embrace market returns. Instead of chasing elusive outperformance, invest in broad, passive index funds that give you exposure to the entire market. By doing so, you automatically own hundreds or thousands of companies, capturing the collective growth of the economy without the need to pick winners or time the market. You trade stress, complexity, and guesswork for simplicity, stability, and peace of mind. Let me illustrate this with a powerful example. The legendary S&P Indices versus Active SPIVA reports. These annual studies track the performance of actively managed funds compared to market benchmarks like the S&P 500. The results are staggering. Over a 10-year period, more than 85% of actively managed large-cap funds underperform the S&P 500. Stretch that to 20 or 30 years, and the underperformance rate climbs even higher. In other words, the vast majority of investors paying high fees for expert management would have been better off simply buying the market through a low-cost index fund. Here's the kicker. Many of these funds still charge hefty fees regardless of performance. So not only are most investors failing to beat the market, they're also paying a premium for the privilege of falling behind. It's a lose-lose situation that millions fall into every year, chasing an illusion sold by Wall Street marketing. John Bogle's wisdom cuts through this noise with refreshing simplicity. He famously said, "Don't look for the needle in the haystack, just buy the haystack." That haystack is the total market, the sum of all businesses that drive economic growth. When you own the market through index funds, you eliminate the impossible task of predicting winners and losers. Instead, you harness the long-term upward trajectory of the economy itself. This strategy doesn't promise overnight riches, but it does offer the most reliable, low-stress, and cost-effective path to building wealth over time. Markets will rise and fall. Individual companies will thrive or fail. But broad, diversified index investing ensures you're not dependent on any single prediction, stock, or fund manager. Consider the story of Jack and Emily, two average investors with similar incomes and savings goals. Jack believes he can outsmart the market. He spends hours researching, reading analyst reports, switching funds, and trying to time his buys and sells. Meanwhile, Emily follows Bogle's advice. She invests consistently in a broad market index fund, ignores the noise, and focuses on the long term. Fast forward 30 years, despite Jack's constant efforts, his returns lag behind the simple, steady growth of Emily's index fund portfolio. Jack is stressed, frustrated, and disappointed. Emily, on the other hand, enjoys substantial compounded wealth, achieved not through complexity, but through common sense. The question every investor must ask themselves is simple. Are you playing the losing game of trying to beat the market, constantly reacting, guessing, and paying high fees? Or are you choosing the simple winning strategy of owning the market, staying the course, and letting time and compounding do the heavy lifting? It's not flashy, but it works. The proof is in decades of data, countless success stories, and the undeniable math of long-term investing. Chasing market-beating returns is a fool's errand for most, but owning the market through passive index funds is the smartest bet for building real, lasting wealth. So as you reflect on your own investment approach, ask yourself honestly, are you playing the losing game of chasing illusions and complexity? Or are you ready to embrace the simple, common-sense strategy that has transformed the financial futures of millions? The choice is yours, and the results, compounded over time, will speak for themselves.
Chapter 4. The Power of Index Funds. Own the whole market. There's a quiet revolution in the world of investing that has transformed the financial lives of millions. It doesn't involve complicated algorithms, risky stock picks, or trying to predict the next big thing. Instead, it revolves around one simple, powerful idea: owning the entire market. And the tool that makes this possible? Index funds. In The Little Book of Common Sense Investing, John C. Bogle champions index funds as the most effective, low-cost, and stress-free way for ordinary people to build lasting wealth. It's an idea so elegantly simple that many overlook its power, but those who embrace it often change their financial destiny. At its core, an index fund allows you to own a slice of every major company in a particular market automatically and effortlessly. Rather than trying to pick winners and avoid losers, you buy into the entire market, capturing its overall growth and reducing your exposure to the risk that comes with betting on individual stocks. With a single investment, you're diversified across industries, sectors, and companies, from the giants of technology to consumer goods, healthcare, energy, and beyond. Why does this matter so much? Because diversification is one of the few free lunches in investing. By spreading your money across hundreds or even thousands of companies, you minimize the impact of any single business's failure. If one company stumbles, the others help balance the loss. And when the economy grows, as it has consistently over the long term, you ride that upward wave without the stress of stock picking or market timing. Bogle often said that investing isn't about finding the needle in the haystack, it's about owning the entire haystack. That's exactly what broad market index funds offer. Funds like the S&P 500 Index Fund or Total Stock Market Index Fund give you exposure to the biggest, most successful companies driving the economy forward. You're not betting on individual success stories, you're participating in the collective growth of the market itself. This approach simplifies investing in a way that removes complexity, emotion, and costly mistakes. Instead of reacting to market noise, chasing hot stocks, or switching strategies every few months, you stay invested in the broad market, letting compounding and time do the heavy lifting. The practical application is straightforward. Choose broad market index funds with low fees and wide diversification.
The S&P 500 Index Fund, for example, tracks the performance of 500 of the largest, most influential companies in the U.S. It represents a significant chunk of the overall economy, including household names like Apple, Microsoft, Amazon, and Google. By investing in an S&P 500 index fund, you automatically gain ownership in these companies and many more. For even broader exposure, total stock market index funds include thousands of companies of all sizes, large cap, mid cap, and small cap, giving you even a wider safety net and more complete participation in market growth. These funds are designed for simplicity, efficiency, and long-term performance. You don't need to be a financial expert to succeed with index funds. You don't need to track individual stocks or obsess over economic forecasts. You simply invest regularly, stay disciplined, and let the market work for you. History shows that over the long term, markets trend upward despite short-term volatility, economic cycles, and political events. By owning the market through index funds, you position yourself to benefit from this natural growth without the stress or guesswork. The rise of Vanguard, the investment firm founded by John Bogle, is a testament to the power of index funds. When Bogle launched the first retail index fund in 1976, he was ridiculed by Wall Street insiders who called it Bogle's folly. At the time, the idea of settling for average market returns instead of chasing outperformance was seen as radical, even foolish. But Bogle understood the relentless drag of high fees, the near impossibility of consistently beating the market, and the immense value of broad diversification. Fast forward to today, and Vanguard's index funds have helped millions of ordinary investors quietly become millionaires. Not through risky bets or market timing, but by patiently owning the market, minimizing costs, and letting time and compounding do the rest. Consider the story of Mark and Lisa, an average couple with modest incomes and no background in finance. They didn't have time to research stocks or decode complicated investment strategies, but they understood the power of index funds. They started investing consistently in a low-cost total stock market index fund, ignored market fluctuations, and stayed the course for 30 years. Today, they've built substantial wealth, not because they outsmarted Wall Street, but because they embraced simplicity, diversification, and patience. This is the beauty of index funds. They leveled the playing field. You don't need insider knowledge, expensive advisors, or hours of research. You simply own a slice of the market, reduce your risks through diversification, and benefit from the long-term growth of the economy. Yet many investors still overcomplicate their portfolios, chasing hot trends, jumping from fund to fund, or falling for the illusion that complexity equals success. But the data tells a different story. Time and again, broad market index funds outperform most actively managed funds, especially after accounting for fees. The simplicity of owning the market often beats the complexity of trying to outsmart it. So, as you reflect on your own investment approach, ask yourself, are you overcomplicating your investments, chasing unnecessary risks, and falling for market noise? Or are you keeping it brilliantly simple, owning the whole market through low-cost index funds and trusting in the proven power of diversification? John Bogle's legacy reminds us that wealth building doesn't have to be complicated or stressful. With index funds, you can own the world's most successful companies, reduce your risk, and enjoy the benefits of market growth, all while avoiding the costly traps that derail so many investors. The power of index funds is real, it's accessible, and it has transformed countless lives. The question is, will you harness that power for your own financial future?
Chapter 5. Time is your greatest ally. The magic of compounding. If there's one universal truth in the world of wealth building that often gets overlooked, it's this: time is your greatest ally.
Not luck, not timing the market, not chasing the next big stock, just pure, patient time. And when combined with the magic of compounding, time has the power to turn small, consistent investments into staggering amounts of wealth. In the little book of Common Sense Investing, John C. Bogle drives this point home with clarity. Wealth isn't built overnight. It's built steadily, quietly, through the consistent power of compounding returns over time. So what exactly is compounding? It's often called the eighth wonder of the world, and for good reason. Compounding is the process where your money earns returns, and those returns themselves start earning returns, creating a snowball effect of growth. Over time, the pace of that growth accelerates beyond what most people can imagine. It's exponential, not linear. But here's the catch. Compounding needs time to work its magic. The longer your money stays invested, the more powerful the compounding effect becomes. Imagine planting a tiny seed. In the beginning, it looks insignificant, barely noticeable. But with time, sunlight, and patience, that seed grows roots, sprouts, and eventually transforms into a towering tree. The same is true for your investments. In the early years, growth might feel slow or unimpressive, but stay the course, and eventually your portfolio grows beyond anything your initial contributions alone could have achieved. That's why starting early, even with small amounts, can lead to massive wealth over decades. It's not about having huge sums to invest right away. It's about giving your money time to work harder than you ever could. The earlier you begin, the more your returns can compound, and the less you need to contribute out of pocket to reach your financial goals. Let me illustrate this with a powerful real-life example that Bogle and countless financial experts often use to demonstrate the shocking impact of time and compounding. Imagine two investors, Sarah and James. Sarah starts investing at age 25, contributing $500 per month into a broad market index fund, earning an average annual return of 7%. She stays consistent for 10 years, then stops contributing entirely at age 35, but leaves her investments untouched, allowing them to grow. James, on the other hand, waits until age 35 to start investing. He contributes the same $500 per month at the same 7% annual return, but he continues investing every month until age 65. Now let's look at the results. Sarah invested for only 10 years, a total of $60,000 contributed, and then let time and compounding do the rest. By age 65, her portfolio has grown to approximately $602,000. James invested for 30 years, a total of $180,000 contributed. But by age 65, his portfolio is worth around $540,000. Let that sink in. Sarah invested for just a third of the time James did, contributed a third of the money, yet ended up with more wealth, all because she started earlier and allowed time to amplify her returns. That's the undeniable magic of compounding. This example isn't hypothetical. It's grounded in real math and real market behavior. It highlights why time in the market is far more important than timing the market. Chasing the perfect entry point, waiting for ideal conditions, or delaying your investment journey often cost you far more than any temporary market downturn ever could. But despite this, many people hesitate to invest. They get caught up in short-term market noise, fear volatility, or convince themselves they'll start later when conditions feel safer. The problem is, every year you delay is another year lost to the compounding process, a year your money could have been working for you, earning returns and growing exponentially. Bogle emphasizes the importance of ignoring short-term distractions and focusing on consistent, long-term investing. Markets will rise and fall. There will be recessions, crashes, and periods of uncertainty. But over decades, broad market indexes have consistently trended upward, rewarding those who stayed invested and let compounding work its magic. That's why the most successful investors aren't necessarily the ones with the most money to start with. They're the ones who start early, stay consistent, and understand that time is their most powerful asset. You don't need to be perfect. You don't need to predict the future. You just need to get started and stay the course. Consider the story of Lisa, a young professional who began investing in index funds with modest monthly contributions straight out of college.
Her friends told her to wait, that the market was risky, that she didn't earn enough to invest, or that she should focus on spending her money elsewhere. But Lisa understood the power of compounding. She stayed consistent, ignored market headlines, and invested every month. Decades later, Lisa isn't just financially secure, she's built significant wealth, far beyond what many of her peers imagined possible. All without gambling, guessing, or stressing over daily market moves. Her secret? She gave her money time to work harder than she ever could, through the quiet, consistent magic of compounding. Bogle's message is clear. Compounding is your greatest wealth-building ally, but it requires patience and discipline. Every year you stay invested, your money grows stronger, your returns compound, and your financial future solidifies. So let me leave you with this reflective question. Are you giving your money enough time to work harder than you ever could? Or are you holding back, waiting for the perfect moment and losing precious years that could be compounding in your favor? The sooner you embrace this truth, the sooner you unlock the exponential growth that only time and consistent investing can deliver. Don't underestimate the power of small steps taken early. Start now, stay consistent, and let time and compounding turn your ordinary contributions into extraordinary wealth.
Chapter 6. Market Returns versus Investor Returns. Behavior matters. Here's a hard truth that most investors don't like to hear. The stock market often delivers impressive long-term returns, but the average investor earns far less than what the market offers. How's that possible? If the market grows, shouldn't investors naturally benefit? In theory, yes. But in reality, human behavior, fear, greed, impatience, gets in the way. John C. Bogle, in the Little Book of Common Sense Investing, reminds us that building wealth isn't just about market performance, it's about investor behavior. And for many, behavior is the biggest obstacle standing between them and financial freedom. This concept is known as the behavior gap, a term coined by financial advisor Carl Richards. It describes the painful difference between market returns and the lower, often disappointing returns that investors actually earn due to their emotional decisions. In simple terms, markets may average 7 to 10% annual returns over time, but the average investor might only see 4 to 5%, sometimes even less. Not because the market underperformed, but because the investor mismanaged their own behavior. Why does this happen? It's human nature. We're emotional creatures wired for survival, not investing. When markets crash, headlines scream panic, and your portfolio starts bleeding red, your instincts tell you to run, to sell, to protect what's left. On the flip side, when markets surge, when everyone's making money, the fear of missing out, FOMO, kicks in, tempting you to chase trends, jump into risky investments, or buy high. These reactions feel logical in the moment, but over time, they sabotage your returns. Behavior, more than market fluctuations, determines long-term success. Let me illustrate this with a real-world example backed by years of research. Dalbar, a financial services research firm, has studied investor behavior for decades. Their reports consistently show that the average investor significantly underperforms the market. For instance, between 1994 and 2013, a period when the S&P 500 returned about 9% annually, the average equity investor earned only around 2 to 3% per year. That's a massive gap, driven entirely by poor decisions, like panic selling during downturns and chasing hot markets at the wrong time. It's not that these investors lacked access to good opportunities. They simply let emotions override discipline. They bought high, sold low, and repeated the cycle, turning temporary market fluctuations into permanent losses. This is the hidden danger of investing. The market's volatility isn't the enemy. Your emotional reactions to it are. Bogle's philosophy is rooted in recognizing this human flaw and building an investment approach that minimizes its impact. His solution? Remove emotion from the equation. Invest consistently in low-cost, broad-market index funds. Automate your contributions. Ignore short-term noise. And above all, stay invested, especially during downturns. Staying invested doesn't mean ignoring risk or blindly holding through extreme situations. It means understanding that market volatility is normal, that declines are temporary, and that the long-term trajectory of diversified markets is upward. History has shown this time and again. Markets have weathered wars, recessions, political upheaval, and crises. Yet over the decades, they've consistently grown, rewarding patient, disciplined investors. Consider the story of two investors, Mike and Emily. Both invested in index funds during a strong market period. When the inevitable downturn arrived, Mike panicked. He sold his investments at a loss, vowing to wait until things felt safe. Emily, on the other hand, stayed the course. She continued her automated contributions, ignored the headlines, and trusted the process. When the market recovered, as it always does over time, Emily's portfolio bounced back stronger, compounded further, and grew exponentially. Mike, however, missed the recovery, hesitated to re-enter, and ultimately lost out on significant gains. Same market, same opportunities, but dramatically different outcomes, all driven by behavior. This is the behavior gap in action. It's the silent wealth killer that turns average investors into frustrated ones and disciplined investors into success stories. So, how do you protect yourself from your own emotions? It starts with awareness. Accept that fear and greed are natural, but you don't have to act on them. Create an automated investment plan. Contribute regularly to index funds without needing to time the market. Automation removes the decision-making process, keeping you consistent even when emotions flare. Next, adopt a long-term mindset. Investing isn't a sprint, it's a marathon. Markets will have bad days, months, or even years, but history rewards those who endure. By focusing on the decades ahead rather than the daily fluctuations, you position yourself to benefit from compounding growth while avoiding costly emotional decisions. Bogle emphasized this repeatedly. Successful investing is about staying the course. That means holding your investments during good times and bad, tuning out the noise, and trusting in the power of the market over time. Let's be honest, it's not always easy. When markets crash, fear feels overwhelming. But the data is clear. Those who sell during downturns often lock in losses, while those who stay invested and even buy more reap the rewards when markets inevitably recover. It's also crucial to set realistic expectations. Markets won't rise every year. Volatility is part of the journey. But with broad diversification through index funds and a disciplined, automated strategy, you minimize risk and maximize your chances of long-term success. Bogle's legacy isn't just about low-cost investing. It's about empowering ordinary people to overcome emotional pitfalls and build wealth through simple, disciplined strategies. The market provides the returns. Your behavior determines whether you capture them. So, here's your reflective question. Are your emotions managing your investments, or is discipline driving your future? Are you reacting to fear, greed, and headlines, or are you calmly, consistently investing with patience and purpose? The greatest advantage you can give yourself isn't finding the perfect stock or timing the market. It's mastering your behavior, staying the course, and letting the power of time and compounding work for you. In the end, the market rewards those who stay calm, disciplined, and committed despite the noise, the fear, and the inevitable ups and downs along the way.
Chapter 7. Ignore the noise. Media, experts, and predictions. If there's one thing the financial world produces in endless supply, it's noise. You know the type. The bold headlines predicting imminent market crashes, the television experts arguing over the next big economic disaster, the endless stream of opinions, forecasts, and breaking news alerts designed to trigger your fear or greed.
But here's the hard truth John C. Bogle shares in the Little Book of Common Sense Investing. The vast majority of this noise is not designed to help you. It's designed to control you. The financial media thrives on fear, hype, and uncertainty because that's what grabs your attention. But reacting to that noise often leads to poor decisions, missed opportunities, and derailed financial futures. Think about it. How often do you see headlines screaming, "Markets set to soar for decades ahead"? Rarely. But predictions of crashes, recessions, or financial collapse, those dominate the news cycle. Why? Because fear sells. Fear keeps you glued to the screen, clicking articles, tuning into market updates, and hanging on to every word from so-called experts. It's an endless loop of anxiety that benefits media companies, not your investment portfolio. Bogle's message is simple, yet powerful. To succeed in building wealth, you must learn to tune out the noise. Ignore the headlines, dismiss the endless market predictions. Focus instead on your long-term plan, the disciplined, consistent investing approach that's been proven to work for decades. Why does this matter so much? Because history shows that the people who panic and react to market noise often suffer the most. They sell during downturns, buy during euphoric peaks, chase hot trends, or abandon sound strategies, all because they let fear or greed fueled by media noise dictate their actions. The end result? Poor returns, frustration, and the belief that investing is nothing but a gamble. But let's be clear, the problem isn't the market itself. The market has a long, proven track record of growing wealth over time despite short-term volatility. The problem is how investors allow themselves to be swayed by headlines, predictions, and sensationalism. Let me give you a real-world example that proves this point. Over the past several decades, countless market experts have made bold predictions about crashes, recessions, or economic collapse. In the early 1980s, many forecasted that inflation and interest rates would doom the market permanently. In the late 1990s, experts warned the dot-com boom would lead to a catastrophic market implosion. And while there was a correction, long-term investors who stayed the course still saw substantial growth in the years that followed. Fast forward to 2008, during the global financial crisis. Headlines screamed that the system was broken, the economy would never recover, and investing in the market was a lost cause. Many people panicked, sold their investments at rock-bottom prices, and locked in massive losses. Yet those who ignored the noise, stayed invested, or even bought more during the downturn, watched their portfolios grow exponentially in the subsequent bull market. The same pattern repeats over and over. Whether it's the European debt crisis, political turmoil, pandemics, or geopolitical tensions, there's always noise, always reasons to fear. But beneath the noise, businesses continue to innovate, economies adapt, and markets grow. Over decades, the upward trajectory of broad market indexes like the S&P 500 has been remarkably consistent, rewarding those who stayed disciplined and invested. The problem is, reacting to noise often feels logical in the moment. The headlines seem convincing. The experts sound confident. Your instincts tell you to protect yourself. But long-term wealth isn't built on reacting to emotion. It's built on facts, discipline, and perspective. Bogle warns investors not to confuse short-term predictions with sound financial strategy. No one, no expert, no economist, no media outlet can consistently predict where the market is headed in the short term. The people who claim they can are usually selling something, attention, products, or expensive investment services. Meanwhile, ordinary investors caught in the whirlwind of noise make costly, avoidable mistakes. So how do you practically tune out the noise and stay focused on your long-term financial success? First, recognize that the media's goal is not to educate you. It's to grab your attention. Sensational headlines, dramatic forecasts, and fear-driven narratives are designed to keep you engaged, not informed. Second, build an investment plan that doesn't depend on market predictions. A diversified portfolio of low-cost index funds, automated contributions, and a commitment to staying invested through all market cycles gives you a reliable, time-tested foundation. You don't need to guess what will happen next. You need to trust the process. Third, limit your exposure to financial news and market speculation. It's perfectly fine to stay informed, but obsessing over daily market movements, Checking your portfolio every hour or hanging on to every prediction only fuels anxiety and poor decision-making. Consider the story of Ben, an average investor who started his journey with excitement but quickly fell into the trap of following financial news religiously. Every time headlines predicted a downturn, he panicked, sold his holdings, or delayed his contributions. His returns lagged significantly behind the market average, not because the market failed, but because he allowed noise to dictate his actions. Contrast that with Rachel, who built a simple, automated investment strategy focused on broad market index funds. She rarely checked her portfolio, ignored headlines, and stayed consistent through good times and bad. Decades later, Rachel's portfolio thrived, compounded by market growth and unaffected by the endless stream of noise. This isn't to say that challenges, downturns, or economic disruptions don't happen. They do. But history proves that markets recover, businesses innovate, and disciplined investors are rewarded. The people who lose the most are often those who react emotionally to media noise, abandoning sound strategies at the worst possible times. Bogle's advice echoes through the years. Stay the course. Ignore the noise. Focus on what you can control. Diversification, costs, consistency, and your own behavior. The rest is just distraction. So here's the reflective question for you. Are you building wealth based on facts, proven principles, and a disciplined plan? Or are you allowing yourself to be swayed by endless noise, fear-driven headlines, and market predictions that history shows are often wrong? The choice is yours. Tune out the noise, trust the long-term process, and remember, the quiet, consistent investor often builds more wealth than the one who constantly chases the headlines.
Chapter 8. The Simplicity of a Long-Term Plan. In the world of investing, complexity is often mistaken for sophistication. We're led to believe that the more complicated our strategies, the smarter and more successful we'll be. Fancy charts, stock predictions, algorithm-driven funds, constant portfolio tweaks, it all creates the illusion of control and expertise. But John C. Bogle, in The Little Book of Common Sense Investing, strips away that illusion with a simple yet profound truth. Complexity breeds mistakes, while simplicity builds discipline, confidence, and long-term wealth. If you look closely at the habits of successful investors, not the flashy traders on TV, but the quiet millionaires who build lasting wealth, you'll find that most of them don't rely on complicated strategies. Instead, they embrace simplicity. They have a clear, consistent plan. They automate their investments. They avoid unnecessary risks. And most importantly, they stick to that plan for decades, letting the power of time and compounding do the heavy lifting. Why does simplicity work so well? Because human behavior is the biggest threat to your investment success. The more complicated your strategy, the more decisions you must make. And every decision becomes a chance for emotion, fear, or overconfidence to creep in. Should I buy more of this? Should I sell now? Is this stock better than that one? This constant decision-making creates stress, second-guessing, and ultimately mistakes that chip away at your returns. But a simple, long-term plan eliminates much of that noise. With clear rules, automated processes, and a focus on proven principles, you reduce the temptation to tinker with your portfolio based on emotions or market fluctuations. You create a system that runs almost on autopilot, allowing you to focus your energy elsewhere while your investments quietly grow. At the heart of this simple approach is the index fund. By investing in broad market index funds like those tracking the S&P 500 or total stock market, you automatically own a piece of hundreds or thousands of companies. You're instantly diversified, reducing risk without the need to handpick individual stocks. You don't have to worry about predicting winners or reacting to short-term market swings. You simply participate in the overall growth of the economy. To make it even more foolproof, automate your contributions. Set up automatic transfers from your bank account to your investment account each month. Whether the market is soaring or dipping, you keep buying shares consistently. This strategy, known as dollar cost averaging, smooths out the impact of volatility and ensures you stay invested over time. Rebalancing is the only occasional adjustment needed. As your portfolio grows, certain assets might drift from your intended allocation. Maybe stocks outperform bonds, for example. Rebalancing simply means adjusting your investments back to their target percentages. You're not timing the market, you're maintaining your long-term plan. Let's look at a real-world example. Meet David and Clara, two friends with very different investing styles. David is drawn to complexity. He follows market news obsessively, experiments with different funds, buys individual stocks, and constantly tweaks his portfolio based on expert predictions. At first, it feels exciting, but over time, the stress, poor timing, and transaction fees erode his returns. His wealth grows slowly, if at all. Clara, on the other hand, follows a simple long-term plan. She invests in a low-cost S&P 500 index fund every month automatically. She rarely checks her portfolio. She rebalances once a year. She ignores the headlines. Fast forward 30 years, Clara's portfolio has quietly compounded into significant wealth, far surpassing David's despite his constant activity. This is not a hypothetical story. Research shows time and time again that investors with simple, consistent plans outperform those who constantly tinker or chase market trends. In fact, studies by firms like Fidelity reveal a surprising truth. The investors with the best performance are often those who forgot they even had an account. Why? Because they weren't making emotional, short-term decisions. Their plan was so simple, they stuck to it. Sometimes by accident, but always to their advantage. The beauty of a simple long-term plan is that it removes guesswork, builds confidence, and protects you from your own worst instincts. You don't need to predict recessions, election outcomes, or market crashes. You don't need to monitor every company's earnings report. You stay focused on your process, trust the historical upward trend of diversified markets, and let time do the rest. Of course, simplicity doesn't mean laziness. It means focusing your efforts on the right things, the things within your control. You control your savings rate, your investment choices, your fees, and your discipline. The market, economic cycles, and global events, those are outside your control. A simple plan keeps you grounded, focusing only on what truly matters. Bogle's legacy has created countless quiet millionaires, ordinary people with ordinary incomes who invested steadily, ignored the noise, avoided complexity, and let compounding wealth work in their favor. These investors didn't gamble on cryptocurrencies, chase meme stocks, or jump in and out of the market based on fear or hype. They followed a plan so simple, they actually stuck to it. Ask yourself honestly, is your investment strategy so simple you actually stick to it? Or have you fallen into the trap of overcomplication, constantly reacting, adjusting, and second-guessing your approach? The most successful investors aren't those who know every market statistic or chase the latest trends. They're the ones with the humility to accept that markets are unpredictable and the discipline to follow a simple, consistent plan regardless of short-term noise. In the end, simplicity isn't just a strategy. It's a competitive advantage. When others panic, you stay steady. When others chase complexity, you build quiet confidence. And over decades, the wealth you create by sticking to a simple long-term plan will often far exceed the returns of those who complicated their way to mediocrity. John Bogle's legacy is proof that investing doesn't have to be complicated to be successful. With broad diversification, low costs, automated contributions, and periodic rebalancing, you can build lasting wealth the common sense way. Stay simple, stay consistent, and watch what decades of disciplined investing can do for your future.
Chapter 9. Understand risk, volatility versus permanent loss. One of the most misunderstood aspects of investing is risk. The moment people hear the word risk, their minds race to images of stock market crashes, losing everything, and their hard-earned savings vanishing overnight. But in the little book of Common Sense Investing, John C. Bogle makes a crucial distinction. Risk is not about short-term market swings. It's about how you respond to those swings.
The real danger isn't volatility. It's making emotional decisions that turn temporary declines into permanent losses. Let's start by understanding what volatility actually is. Volatility simply means that markets go up and down. Sometimes those fluctuations are small, barely noticeable. Other times they're dramatic, grabbing headlines and sparking panic. But here's the key. Volatility is temporary. Markets rise, markets fall, and over time, markets recover. Permanent loss, on the other hand, happens when you react to volatility by selling your investments in fear. When you lock in losses by exiting the market during downturns, you convert paper losses into real ones. You miss the recovery, you sabotage your long-term growth, and you potentially derail your financial future. That is the true risk, not the market's natural ups and downs, but your emotional reactions to them. Why does this distinction matter so much? Because if you misunderstand risk, you'll struggle to stay invested when it matters most. You'll panic during downturns, sell at the worst possible times, and miss the inevitable market rebound. But if you understand that volatility is normal and that staying the course is your best defense, you position yourself for long-term success. Let me share a powerful example that perfectly illustrates this. In 2008, the world faced one of the worst financial crises in history. Markets plummeted, banks collapsed, headlines screamed economic doom. Investors watched their portfolios lose 30%, 40%, even 50% of their value in a matter of months. Fear was everywhere. Many investors, gripped by panic, sold their holdings at the bottom. They couldn't stomach the temporary volatility, so they turned it into permanent loss. They missed the recovery that followed, the historic bull market that saw stock prices soar to record highs over the next decade. But the investors who stayed the course, the ones who understood the difference between volatility and true loss, held on through the storm. They didn't sell. Some even continued to invest, buying more shares at discounted prices. Fast forward to today, and many of those investors have seen their portfolios not only recover, but grow significantly beyond pre-crisis levels. This isn't just about the 2008 crisis. The same pattern has repeated after every major downturn. The dot-com bubble burst, Black Monday in 1987, COVID-19's market panic in 2020. Each time, markets eventually recovered, rewarding those with patience and discipline, punishing those who let fear dictate their decisions. Bogle's approach to risk is rooted in this long-term perspective. He reminds us that the market's short-term behavior is unpredictable, often volatile, but its long-term trend is upward. The broad market indexes, driven by business innovation, productivity, and economic growth, have consistently delivered positive returns over decades. When you invest in a diversified index fund, you're buying into that long-term growth. But you must also accept that temporary declines are part of the journey. Expect them, prepare for them, but don't fear them. Volatility is the price of admission for building wealth. So, how do you practically manage risk the smart way? First, adjust your mindset. Stop viewing market dips as disasters. Instead, see them as temporary events that you've planned for. Second, build your portfolio with appropriate diversification. Index funds naturally provide broad exposure to many companies, reducing the risk tied to any single business. Third, hold a time horizon that matches your goals. Money you need in the short term should not be in the stock market, but for long-term wealth building, retirement, generational wealth, financial freedom, the stock market remains one of the most effective tools available despite its short-term fluctuations. Fourth, automate your investments. Regular contributions ensure you buy through all market conditions, highs, lows, and everything in between. This strategy, known as dollar-cost averaging, helps reduce the emotional impact of volatility. You're not trying to time the market, you're consistently participating in its growth. Understanding risk also means recognizing your emotional triggers. If you know market downturns make you anxious, avoid checking your portfolio daily. Limit exposure to sensationalist financial news. Remind yourself of the historical data, the countless times markets have fallen, recovered, and rewarded patient investors. Let me share the story of Samuel, an ordinary investor with a long-term goal of retiring comfortably. When COVID-19 hit in 2020, markets crashed seemingly overnight. Fear swept the globe. Samuel's portfolio took a sharp hit, but unlike many who panicked, Samuel remembered Bogle's principles. He stayed invested, continued his automated contributions, and refused to react emotionally. Just months later, markets rebounded. His portfolio recovered, then grew beyond its pre-crisis value. Today, Samuel is well on track to achieving his financial goals, all because he understood the difference between volatility and permanent loss, and he stayed the course. Here's the truth. Volatility will never disappear. Market downturns, corrections, and bear markets are inevitable, but so are recoveries, bull markets, and long-term growth for those who remain disciplined. So let me ask you a reflective question. Are you prepared to ride the waves of market volatility, or will fear sink your financial ship? The difference between success and failure in investing often comes down to this one choice. If you react to every downturn with panic, you convert temporary discomfort into permanent loss. But if you educate yourself, embrace volatility as part of the process, and stay invested with discipline, you'll weather the storms and emerge stronger on the other side. John C. Bogle built his legacy on this truth. His creation of the low-cost index fund gave everyday investors a powerful, simple tool for building wealth. But even the best tools require the right mindset. Understanding risk, accepting volatility, and resisting fear is essential to unlocking the market's long-term rewards. Stay the course, ride the waves, and remember, the greatest risk isn't the market's natural ups and downs, it's letting fear, impatience, or confusion steer you off track. Master this lesson, and you'll master the art of building wealth the common sense way.
Chapter 10. The Investor's Greatest Strength, Patience. If there's one quality that quietly separates successful investors from those who struggle, it's not intelligence, luck, or timing. It's patience. In The Little Book of Common Sense Investing, John C. Bogle repeatedly emphasizes that true wealth is not built through speculation, frantic trading, or chasing market trends, but through the quiet, steady practice of patience. And yet, in today's fast-paced world, patience is in short supply. Think about how we've been conditioned. Instant notifications, 24-hour news cycles, real-time stock tickers, all designed to fuel impatience. We're constantly bombarded with information that makes it feel like we should do something every time the market moves. But successful investing isn't about constant action, it's about disciplined inaction. It's about planting seeds today and letting time, compounding, and market growth work their magic over years and decades. Why is patience so powerful? Because wealth building in the market is rarely a straight line. It's a winding, often volatile journey filled with ups, downs, and periods of stagnation. Many people lose faith when their investments dip or don't grow as quickly as they hoped. They abandon their strategy at the first sign of trouble, digging up their financial seeds before they've had time to sprout. But the market rewards those who can wait, those who can endure the temporary noise, downturns, and disappointments without losing sight of the bigger picture. Compounding, market recoveries, and exponential growth, all of it requires time. Consider one of the most famous examples of patience paying off, Warren Buffett, one of the world's most successful investors. People often marvel at his billions and his reputation as the Oracle of Omaha. But what many overlook is how his wealth truly exploded thanks to decades of patience and consistent investing. Buffett started investing as a teenager, building his knowledge, experience, and portfolio over time. But here's the fascinating part. According to data from financial historians, nearly 90% of Buffett's current wealth was accumulated after he turned 50. That's right. The billions he's known for didn't magically appear in his 20s or 30s. They were the product of steady, patient investing compounded over many decades. His secret wasn't picking the hottest stocks or timing the market with precision. It was allowing his investments to compound uninterrupted for over 70 years. He understood that time in the market is far more powerful than trying to outsmart the market. His patience allowed compounding to do its work, turning modest early gains into unimaginable wealth later in life. This isn't unique to Buffett. It's the universal math of wealth building. The longer you stay invested, the greater the exponential effect of compounding. Your returns earn returns. Those returns generate more returns.
Over decades, the curve of your wealth accelerates dramatically, but only if you have the patience to stay the course. Bogle knew this well. His creation of the low-cost index fund was built for the patient investor, those willing to own a broad slice of the market, contribute consistently, ignore the headlines, and wait for time to amplify their efforts. Yet patience remains one of the hardest virtues to practice in investing. Why? Because the market tests your patience constantly. One year, your portfolio is soaring, the next, it's down 15%. A decade may pass with modest returns, only to be followed by explosive growth. If you lack patience, you abandon ship at the worst moments, missing the very growth you were waiting for. It's like planting a tree. You don't dig it up every few months to check the roots. You water it, nurture it, and trust that time will bring growth. The same principle applies to investing. Every contribution you make, every share you buy, is a seed for your future. But the harvest requires time, often far more time than we expect or desire. Let me share the story of Anna, an ordinary investor who understood the power of patience. Anna started investing in broad market index funds in her 20s. Her contributions were modest, just a few hundred each month. The early years were uneventful. Her portfolio grew slowly, and market downturns occasionally erased her gains. But Anna didn't panic. She didn't jump ship or chase hot trends. She stayed consistent, stuck to her plan, and trusted the process. Decades passed. Her investments compounded quietly in the background. By her 50s, her portfolio had grown significantly, providing financial security beyond what she ever imagined. Her friends, some of whom had chased quick wins or reacted to every market dip, struggled to match her results. The difference wasn't flashy stock picks, it was patience. Anna's story reflects the same lesson Bogle, Buffett, and generations of successful investors have lived by. Time is the most powerful force in wealth building, and patience is how you harness it. So how do you cultivate patience in your investing journey? First, set realistic expectations. Understand that markets fluctuate, downturns happen, and periods of low returns are normal. But history shows that over decades, markets reward disciplined investors. Second, automate your investments. Consistent, scheduled contributions remove the temptation to time the market or react emotionally. You invest regardless of market conditions, ensuring your seeds are planted steadily. Third, focus on your long-term goals. Investing isn't about what happens this week or next quarter. It's about building financial freedom, security, and wealth for your future self. Keeping your eyes on that horizon makes it easier to endure short-term discomfort. Finally, remind yourself of the stories, the countless investors who stayed the course, practiced patience, and built lasting wealth, contrasted with those who let impatience sabotage their future. Here's your reflective question. Are you planting seeds for tomorrow or digging them up every time the market shakes? The truth is, markets will always test your patience. There will always be volatility, uncertainty, and moments of doubt. But if you stay disciplined, consistent, and patient, you give your investments the greatest gift of all: time. Bogle's wisdom reminds us that building wealth doesn't require genius, luck, or constant action. It requires patience, the willingness to stay the course, trust the process, and let the quiet, steady force of compounding transform your efforts into extraordinary results. So plant your seeds, water them with consistent contributions, and let time work its magic. In the end, patience isn't just a virtue in investing, it's the foundation of true, lasting wealth.
Chapter 11. Common Sense Investing is for Everyone. One of the most powerful messages from the Little Book of Common Sense Investing by John C. Bogle is this: you don't need to be rich, connected, or financially gifted to build real wealth. You don't need insider tips, complicated strategies, or a Wall Street career. Common sense investing, the simple, disciplined approach of owning broad market index funds, minimizing costs, and staying the course, is available to everyone. And for decades, it has quietly transformed the lives of ordinary people from every walk of life. Wall Street, however, would have you believe otherwise. For years, financial institutions, media outlets, and self-proclaimed experts have built a narrative that investing is complex, mysterious, and best left to the professionals. Why? Because confusion keeps people dependent. If you believe investing is too complicated, you'll pay high fees for active fund managers, consultants, or overpriced financial products. You'll stay trapped in the cycle of paying others to manage your money while they profit and you fall behind. Bogle spent his life challenging that system. His mission was to empower everyday people, teachers, janitors, nurses, factory workers, small business owners, to take control of their financial futures using simple, proven principles. His creation of the index fund wasn't designed for the wealthy elite, it was built for the masses, for anyone willing to invest consistently, ignore short-term noise, minimize costs, and stay the course and trust the power of long-term market growth. And the results speak for themselves. Across America and around the world, ordinary people, many with modest incomes, have quietly built substantial wealth through common-sense investing. No stock picking, no day trading, no market timing. Just disciplined ownership of broad market index funds and the patience to let compounding work over decades. Consider the story of Maria, a public school teacher from Ohio. Maria never earned a six-figure salary, she didn't have a finance degree or access to exclusive investment opportunities, but what she did have was discipline. Early in her career, she started investing a small portion of each paycheck into a low-cost index fund. She automated her contributions, stayed invested through market ups and downs, and ignored the financial news circus. Fast forward 35 years, and Maria retired with a seven-figure portfolio, more than enough to live comfortably, travel, and support causes she cared about. Her wealth wasn't the result of winning the lottery, inheriting money, or risky bets. It was the quiet power of common-sense investing, available to anyone. Maria's story isn't unique. Across the globe, janitors, nurses, mechanics, office workers, people from all backgrounds have built financial security by following Bogle's simple blueprint. They didn't fall for Wall Street's complexity narrative. They educated themselves, trusted the process, and took consistent action. And yet so many people remain on the sidelines. Why? Fear, misinformation, and the belief that investing is only for the rich or the highly educated. But Bogle shattered that myth. He showed that the greatest barriers to building wealth aren't lack of opportunity, they're lack of access to simple, honest information and the courage to get started. The reality is, the financial system can seem intimidating. Complex jargon, endless acronyms, and sensational headlines create a fog of confusion. But beneath that fog, the truth is refreshingly simple. You can own a piece of the world's greatest companies through broad market index funds. You can minimize fees, taxes, and emotional mistakes by following a long-term passive approach. And you can build wealth steadily, regardless of your income level, by staying consistent and patient. Common sense investing isn't about gambling on hot stocks or reacting to every market fluctuation. It's about understanding that over time, businesses grow, economies expand, and markets reward disciplined ownership. When you invest in an index fund, you participate in that growth without the complexity, high costs, or guesswork. But perhaps the most empowering part of Bogle's philosophy is this: you don't have to be perfect. You don't need to predict market crashes or time your investments flawlessly. You simply need to get started, stay consistent, and trust the process. Even small, regular contributions can snowball into significant wealth over time. Imagine a young nurse, Mark, just beginning his career. His salary isn't enormous, and he has student loans to manage. But Mark decides to invest $200 a month into a total stock market index fund. It doesn't seem like much at first, but over 30 or 40 years, with market growth and compounding, that small act of consistency could build a portfolio worth hundreds of thousands or even millions of dollars. This is the beauty of common sense investing. Small steps, taken consistently, create extraordinary results. You don't need to start with vast sums, you just need the discipline to start and the patience to stay the course. And this approach isn't limited to a certain age or background. Whether you're 25, 45, or 60, whether you earn a little or a lot, whether you've made financial mistakes in the past or not, common sense investing can work for you. The only requirement is the willingness to take control, educate yourself, and break free from the noise and complexity that keeps so many stuck. Bogle's message is clear. Investing isn't reserved for Wall Street insiders. It belongs to everyone. The janitor, the teacher, the small business owner, the retiree, the young professional, all have the power to build wealth with simple, disciplined strategies. So here's the reflective question for you. Are you ready to reclaim your financial future with common sense? Are you ready to tune out the noise, simplify your approach, and start building wealth the proven, accessible way? You don't need permission from Wall Street. You don't need complex strategies or market predictions. You need a commitment to consistency, the courage to start, and the patience to let your investments grow. Bogle's legacy is living proof that ordinary people can achieve extraordinary financial outcomes, not through luck or complexity, but through common sense. So wherever you are in your journey, know this: the path to wealth is already paved. The only question is, are you ready to walk it?
Building wealth has never been about secret formulas, insider knowledge, or gambling on risky bets. It's not reserved for Wall Street insiders, hedge fund managers, or the financial elite. It's for people like you, ordinary, hard-working individuals with dreams of security, freedom, and a better life. It's for teachers, nurses, mechanics, small business owners, and students. It's for anyone willing to embrace the power of simplicity, patience, and common sense. John C. Bogle's timeless principles, shared in the Little Book of Common Sense Investing, cut through the noise, the hype, and the confusion. He showed the world that building wealth isn't about predicting the next hot stock or timing the market. It's about owning a slice of the world's greatest companies, keeping costs low, staying invested, and letting time and compounding do the heavy lifting. The truth is, your financial freedom doesn't depend on luck. It doesn't hinge on some magical investment strategy only a few people understand. It depends on your willingness to follow proven principles, to stay calm when markets shake, to plant seeds today and give them time to grow, to trust that through patience and discipline, you can achieve real, lasting wealth. So, if this video opened your eyes to the power of common sense investing, do me a favor, smash that like button. It helps spread this message to more people, cutting through the noise of misinformation out there. Drop a comment below and share your biggest insight. Was it the reminder that patience outperforms panic, that fees quietly erode your wealth, or the empowering truth that anyone, regardless of income or background, can build financial freedom through simple, consistent investing? And don't forget to subscribe. This channel is dedicated to bringing you the world's most powerful personal finance lessons, simplified, actionable, and designed to transform your future. Remember this: your financial freedom isn't some distant, impossible dream. It starts today with one simple decision: own the market, stay the course, and let common sense guide your journey. The wealth you seek isn't built in moments of hype. It's built quietly, patiently, through discipline and belief in the process. You have the tools, you have the knowledge. Now it's time to take action. Stay consistent, stay patient, and watch how your future unfolds, one smart, simple step at a time.